Ladies and gentlemen, welcome back to the channel. Here in this video, we will discuss what happened to markets today, the out of nowhere rally we've seen, and then followed by the out of nowhere decline that we've seen, ended up causing Tesla stock to close down 1.72% on the day today, seeing a nice little recovery here in after hours. Same is true with the S&P. The S&P was up, and then it was down, and well, it's going higher by about 0.2% in after hours as well. Now, tomorrow we have our CPI report. The CPI report, I mean, I can't remember a CPI report that was as important as this one. On the precipice of Trump taking office, the Fed really just doing a U-turn on December 18th. The market's really not expecting any cuts at all this year, and with expectations that inflation is going to remain sticky, well, this is a critical inflation report. Now, in this video, I will also explain and show you what the markets are pricing in the options, okay? What Tesla's pricing in by this Friday, and what the S&P is pricing in by this Friday. So that's pretty exciting because options, I mean, a lot of people trade them, but they always have an underlying, amount that they're pricing in over a specific period. And really, Friday's just 3 days, Wednesday, Thursday, and Friday, and you are expecting a volatile market over the next 72 hours. And I want you guys to be fully prepared and know what to expect over this course of time. We will take a look at the option activity, the short positioning, as well as much more in regards to Tesla specifically. If that sounds like something you are interested in, sit back, relax, grab yourself a drink today. Oh my gosh, this is like my favorite. Green tea, the ginseng and honey, Arizona. Terrible for you though. I think it's 84% of your daily sugar in just this one can. Okay, with that said, let's go ahead and get started. So there was a lot of volatility today. I talked about this a lot as we headed into 2025, but there is a headline risk around big tech. Now, if you look at the RSP today, if you look at the equal weight S&P, it was actually up 0.82% on the day versus the S&P that was only up 0.14%. The RSP outperformed the market cap weighted S&P by about 5x. That's a strong outperformance. Now, big tech was really dragged down today for two reasons. Number one, we have recently got news that Microsoft is laying off some of their workforce. And we got news today that Meta is also laying off some of their workforce. Now, I think for companies that hired hundreds of thousands of employees collectively, it's probably a good thing to downsize some of the least productive employees. Like, that's a healthy thing in a business cycle. If you are not a value to a company, you cannot expect to keep your job long term. So I don't really read into this as the start of a larger downturn for the economy, but that is making Wall Street a little bit nervous. Now, the headline risk to the S&P comes from big tech, in my opinion, not Tesla, big tech. Why? Because earnings growth this year is expected to really broaden out and accelerate for other areas besides big tech. The last 2 years, Mag 7 has been Mag 7 because it was really the only place of substantial earnings growth. We're expecting small caps and value and cyclicals and some of the areas that have not participated much over the past 2 years to really have some impressive earnings numbers. Now, couple that with pretty high valuations for big tech versus other areas, and it's not as appealing to own these big tech names. So that's all kind of number one. Number two is today we got our PPI report that came in well below expectations. Core PPI month over month was expected at 0.3%. It came in at 0%. Essentially no inflation in the producer price index for core. Now, if we get a similar report from CPI tomorrow, and we'll talk about what markets are currently pricing in it Nick Timmerhouse always puts together a chart of what major banks are forecasting for CPI. So we'll take a look at that in just a moment. But if we get a big downside surprise to CPI, it doesn't help big tech the way that it helps small caps or any other area of our markets. Why? Because big tech, they've actually benefited from rates being higher for longer. And if inflation comes in on the low side, they're not going to benefit from that anymore. If especially 10-year treasury yields start to come down. 10-year treasury yields were actually down about 2 basis points today, which I take as a little bit of a sign of confidence for tomorrow's CPI report, because you have to remember how bonds are priced, it's inverse, okay? So when bond yields are going up, as they have been recently, bond prices fall. So if markets think we're going to get a hot CPI report tomorrow, which they don't, okay, at least not from what I've seen today, then you would see bond prices fall. So if you're going out and buying bonds today, you would instantly lose money coming tomorrow. It's a sign of confidence, at least, that people went out and they bought the long end of the curve today, meaning they're taking some data risk coming tomorrow. If they're wrong, they're going to lose money. If they're right, they are going to make money. But again, without going too far into all of this and rambling for 10 extra minutes, 10-year treasury yields, if they come down with a stronger than expected CPI report, then big tech really doesn't benefit from that. You can see today, again, the NASDAQ was red and the Russell was up 1.2% today. That is a strong sign that CPI is going to be good coming tomorrow. The VIX was also down about 2.5% today, so less put positioning and more calls essentially that were placed on markets. Now, I showed you guys this in the last video, and I'm not going to read the whole thing again just to save some time here, but weak PPI usually means weak CPI, but not always. So specifically, 21% of the time, if PPI comes in low, then CPI will come in really hot. Okay, so 21% of the time, you have low PPI like we had today, and you're going to have a hot CPI report tomorrow. Only 21% of the time. 39% of the time, CPI comes in line with expectations when you have a very low PPI number. And 39% of the time, you have a really good CPI report, like a soft CPI report, following a soft PPI report. So historically speaking, the softer than expected PPI report today should in theory be good news for a potential, softer than expected CPI report tomorrow. Now, couple this with the news that we have recently gotten that the Trump team is exploring doing a month-by-month step up in tariffs. Instead of doing, call it 25% tariff on Canada immediately, we would do like a 2% or 5% tariff per month until we got up to a certain level. So instead of happening at once, it could take 5 months to 12 months or longer. That would potentially take away some of the knee-jerk inflationary pressures, at least from Wall Street's perspective. We can all argue about what tariffs actually do and what they actually mean. This is from Wall Street's perspective. Doing a slower tariff is better than a faster tariff. It reduces some of the uncertainty. So couple that, and it's a rumor at this point. Trump has not confirmed that, okay? It's still just a rumor. Once we get confirmation, I think the markets will react more to that. That was news that came out yesterday. Couple that with a potentially lower than expected CPI report, and you have a pretty damn good setup considering markets are this bearish. And just briefly, before we look at inflation expectations from the CPI report tomorrow from Nick Timmerhouse's chart, just again, percent of stocks trading above their 50-day moving average. Call it 30%. You've seen a nice little recovery today. About 2.5% of stocks broke above their 50-day moving average today. But still, 70% of stocks are in an active decline. Okay, that's not good. That is the lowest you've still been in all of 2024. This takes you back to October 2023 levels, or before then, it takes you back to, October 2022 levels. And we hit a low of 24, almost 25% of stocks trading above the 50-day moving average. In fact, there is 0 sectors within the S&P, technology, not software, not industrials or cyclicals, value, materials, none of those sectors, semiconductors, none of them, are trading above their 50-day moving average. That is when you know things are bad. You can also see via the Fear and Greed Index on CNN, we did hit extreme fear. This was yesterday at 25, but you're still only at 27. So the markets are not in a great place as is. So yeah, there's a lot of room for some recovery here if things do start to get a little bit better with that CPI report. And if you guys have not followed the X account already, go ahead and give this thing a follow. It gets 0 love. It's just the algorithms just don't like me. So go ahead and give this a follow. I share everything important with Tesla. I share all of the important headlines, literally everything you need to know on a daily basis for markets. Okay. Now, Nick Timiraos, he posted this like he always does. That says, economists who produce detailed inflation forecasts expect the December CPI to show that core prices rose a bit less than in December, up 0.26% to hold the 12-month rate at 3.3%. The median forecast has headline CPI rising a bit more, pushing 12-month inflation at 2.9%. So it's this median forecast you really want to look at. It's the average of all of these forecasts. I'll tell you right now, the lowest forecast is by Employ America at 0.21%. The highest forecast is by, I know there was this one here, by Pantheon Macroeconomics at 0.32%. This is for core CPI month over month. So that's a pretty big difference. Now, as long as we come in around the median forecast, that's just fine. Now, if Wells Fargo and Barclays and Employ America are correct and we come in on the low side of 0.22, maybe even 0.21, then that's really good. If we, for whatever reason, come in even lower than that, that is extremely positive. Now, it will also be important the makeup and the components of CPI. Shelter inflation has fallen now for 2 months in a row. Does that again continue? If we do see a surprise, downside number for shelter, maybe for insurance, then CPI is going to come in low, and Wall Street's going to get more confident about the path of inflation. Again, mix that with the recent Trump rumor, as long as that is true, and we actually get a stepped up tariff basis, not a all at once slap in your face tariff, then I could see a very optimistic kind of scenario starting to play out since markets are as negative as they are. You got to remember, though, there's a rounding effect. So if we come in at the median forecast, the headline is going to read 0.3. Okay, it's going to get rounded up. If we come in at 0.24, it's going to get rounded down. Now, we could also come in at 0.15, 0.15, which is much better than 0.24, but we would still get rounded to 0.2. So I don't think you can really look at the headline itself tomorrow morning and actually know for sure if it's bullish or bearish. You really want to get the actual decimal. That'll tell you a lot, because you could come in at 0.3, which is technically the expectation, but it could be 0.34, higher than all of these estimates. Or it could be 0.26. It's still going to read as 0.3 on the headline, but 0.26 is much better than 0.34. Much better from Wall Street's perspective. So I think that's important. I don't really think headline CPI, this whole column here, doesn't really matter too much, but core CPI month over month is year over year is expected at 3.3%. Now, in November, you had your month over month core CPI at 0.31%. So this would be a deceleration from last month. That's good. As long as we don't accelerate, I think we're probably okay. Okay. If we accelerate, if we come in higher than 0.31, yeah, we're going to have a problem on our hands. Now, I do think that was part of the run up and then sell down that we've seen. I don't necessarily think that CPI was leaked or anything. I know I've heard some people say that, but I don't think CPI was leaked. I do think there's a lot of jitters around CPI. There's a lot of hedging because we are at such a critical inflection moment for markets. And we'll look at the charts here in just a moment. But specifically for Tesla, there's two things going on. I talked about this in the last video. The Elon TikTok rumor, that's worrisome for investors. Now, we have CPI tomorrow. Elon has not said anything about potentially buying TikTok, so it's only a rumor at this point. The longer Elon does not comment on this, the more nervous investors will get. If Elon comes out and comments on this and says, yeah, I have no interest in buying TikTok, great, fantastic, because it's worth $100 billion. It's U.S. operations, and there would be a lot of selling of Tesla stock to make that happen. Although I don't know with the compensation package being in litigation, if that's still even possible for him to buy, TikTok. So we'll see. There's a lot of weird things going on there. But I think that has to do with some of the hedging in Tesla stock today. You've seen 226 different trades totaling $655.63 million with a positive order value of 39%. That's the lowest positive order value I've seen in a long time. Okay, there was a lot of big hedges today. The other part of this is obviously CPI tomorrow. If CPI comes in bad, Tesla's going to fall more than the average stock, way more than the average stock. If CPI comes in good tomorrow, Tesla is going to rally a lot more than the average stock. And I do have a feeling that a lot of folks on Wall Street just recently started to actually take positions in Tesla. So they could be hedging some of those recent positions. Now, if you take a look at the short position today, you actually had 503,000 shares that were covered on. Okay, only 60,000 shares were sold short today, and 563,000 shares were covered on. So there wasn't a lot of shorting activity heading into tomorrow, which I would say is at least to some degree a positive sign. You've also seen the short interest fall from 2.88% down to 2.41%, which it's always good to see short sellers lose their confidence in their short positions and start to cover. Now, by this Friday, Tesla is pricing in a 5.26% move, okay, in the options market. So let me show you just how to do this. You could go ahead and use the strike I like to use the strike that's just out of the money. You can use the strike that's just in the money. It doesn't matter. You're roughly going to get to the same place. So we'll use the strike that is just barely in the money on the call side and add that to the strike that is barely in the money on the put side, which is $1,145 on the call side and $1,110 on the put side, and you're going to come to $22.55. Okay, divide this by the current share price of Tesla, and you're going to get an expected options move of 0.056. So this reads as 5.6%. Now, depending on, again, which one you use, you're going to get slightly different numbers here. If you use the one that's just out of the money on the put side, that's $970. And what's just out the money on the call side is $1,020. So there is a skew towards the call side. So the calls are a little bit more expensive than the puts. I personally think that's always a good sign to see that calls are more expensive than puts. That means people are just willing to pay a little bit more for the calls versus the puts. If you do that way, you're still getting 0.050. So you're still getting exactly 5%. So anywhere from 5 to 5.5%, depending on how you want to calculate this, is what Tesla is pricing in by the end of this week. If we look at the charts, okay, 5% to the upside for Tesla from here would put the stock at about, where is this? 417 or so, 418. 5% to the downside would put the stock at about 376 or so. So I think there is an opportunity with Tesla. Either direction here by the end of this week, if you want to spend the money to trade the options. I also think that means there's a decent hedge if you want to spend the money to actually, trade these. Because if CPI comes in really good, Tesla's going to go up more than 5% tomorrow. If CPI comes in really bad, Tesla's probably going to drop more than 5% tomorrow. So I don't think the options are too egregious. And if we do get a good CPI report, or a bad one really, you could see people pile into short-term options since they are not super, pricey from the standpoint of pricing in that move. And you could actually get a pretty nice gamma move into the end of this week. I would hope it's to the upside, but there is such thing as, daily and weekly puts also. People could pile into the put side and you could see a gamma ramp down just as easy as a gamma ramp up. But that's currently what Tesla is pricing in. Now, before we go ahead and wrap up this video, I will also share with you what the SPY is pricing in by this Friday and also tomorrow. So on the call side, the call that's barely in the money is $487, see plus 4.87. And we got to find the put that's just barely in the money also. And that is going for 4.98. So actually, there's a little bit more of a skew towards the put side for the S&P tomorrow, which is kind of wild because Tesla is the opposite. There's more of a call skew. Now, you come to $9.85 priced in over the next 3 days. Divide that by 583.35, and you're looking at about a 1.68% expected move over the next 3 days. That's kind of a lot. For 3 days, yeah, that's one hell of a move. Okay, now for January 15th, which is tomorrow, this is really just the CPI report and what we're pricing here. On the put side, these options are $378 plus the call side, which is $337. That's like a 10% put skew. So there's definitely some nervousness heading into tomorrow. Those are $337 on the puts that are just in the money. It actually looks like they're just out the money now and after hours. Does not matter. You're pricing in $7.15 on the SPY by tomorrow's close, right? So it's not just the pre-market or when the data comes out, but this is priced for the end of the trading day tomorrow, including after hours. You're looking at an expected move of about 1.2%. That's a lot for a CPI report. I can't remember the last time we were pricing in this much volatility for a CPI report or even really one specific data point. So yeah, we're going to get a pretty crazy move here in the next 24 hours. I lean towards, really it's not even 24 hours, it's like 14 hours or so, but I lean more towards CPI is going to come in on the light side. As long as it's not, again, higher than last month's 0.31%, then I think we're going to be, just fine, right? But if it comes in higher than that, then we have a much bigger problem on our hands. Let me know what you guys think about this down below in the comments section. Ladies and gentlemen, enjoy the rest of your day, and I will see you in the next one.